Volatility. It's the word on everyone's lips on Wall Street. But what does it really mean? Simply put, volatility measures how much a stock's price jumps around. A volatile market is like a roller coaster, lots of ups and downs. High volatility means big price swings. That can be scary for some investors. But for savvy traders, volatility is opportunity knocking. Why? Because big swings mean big potential profits, if you know how to play it right. Think of it like this. When a stock is calm, it's like a lazy river. Not much action, not much profit potential. But when volatility kicks in, it's like hitting those rapids. Things get exciting. That's where options trading comes in. Options give you leverage. You can control a lot of stock with a small amount of money. And in a volatile market, that leverage can supercharge your profits. But remember, leverage cuts both ways. It can amplify your losses too. That's why you need a plan, people. One way to play volatility is with a strategy called a straddle. Sounds fancy, right? It's not that complicated. With a straddle, you're betting a stock will make a big move. You just don't know which direction. You buy both a call and a put option on the same stock. A call option bets the stock will go up, and a put option bets it will go down. You win if the stock makes a big move in either direction. If the stock shoots up, your call option makes money. If it plummets, your put option comes into play. But straddles are expensive. You're paying for two options. The stock has to move a lot for you to make money. When you buy a straddle, you need to consider two things: buying power and time decay. Now, buying power is simple. It's how much money you need to put up to buy the options. Straddles can be pricey, so make sure you have enough cash on hand. Time decay is a bit trickier. Options contracts have an expiration date, and as that date gets closer, the value of the option decays, kind of like an ice cube melting. This decay is called theta, and it's the enemy of the straddle trader. Why? Because for a straddle to be profitable, the stock has to move a lot in a short amount of time. If the stock doesn't move enough before your options expire, you lose. It's like watching paint dry and your money evaporate. So, when should you use a straddle? When you're expecting a big move in a short amount of time. Think earnings announcements, major news events, that sort of thing. But remember, straddles are a high-risk, high-reward strategy. Don't bet the farm. A strangle is similar to a straddle, but you buy a call option with a higher strike price and a put option with a lower strike price. Think of it like casting a wider net. Strangles are cheaper. You're buying options further out of the money, so they cost less. But the stock has to move more for you to profit. Use a strangle when you expect a decent move but aren't sure which way. Now let's talk about the mechanics of a strangle. Just like with straddles, you need to consider buying power and time decay. But because strangles are cheaper than straddles, you won't need as much buying power. However, time decay is still a factor. Remember, options contracts have an expiration date, and their value decays over time. So you need to be right about the direction of the stock move and the timing of that move. The good news is that because strangles are cheaper, you have more time for your trade to work out. But you still need to be mindful of theta, that pesky time decay. It's like a ticking clock on your trade. So strangles can be a good way to profit from volatility without breaking the bank. But remember, they're still a directional bet. You need the stock to move in the right direction to make money. Don't just buy and pray. Now let's dive into something called volatility skew. Sounds complicated, right? Don't worry, it's not as scary as it sounds. Volatility skew is simply a way of measuring how much traders are willing to pay for options. You see, options prices are affected by supply and demand, just like anything else. And when traders are scared, like during a market crash, they're willing to pay more for protection. That means put options get more expensive. This difference in price between put options and call options is called volatility skew. And it can create some interesting trading opportunities. For example, if you think the market is overreacting to bad news, you can sell overpriced put options and collect a premium. Of course, selling naked options is risky business. But if you know what you're doing, volatility skew can be your friend. It's all about understanding how fear and greed drive option prices. Now let's talk about a strategy that's not for the faint of heart: naked options writing. This is where things get really interesting and potentially very risky. With naked options writing, you're selling options that you don't own. Why would you do such a crazy thing? Well, because you get to collect the premium, the price that buyers are willing to pay for the option. It's like being the casino. The odds are in your favor, but if you're wrong, you can lose big. Naked options writing is best left to experienced traders. You need to understand the risks involved and have a plan for managing your trades. It's like playing with fire. You can get burned if you're not careful. But if you know what you're doing, naked options writing can be a powerful tool for generating income. Just remember, it's not a get-rich-quick scheme. It takes patience, discipline, and a whole lot of guts. Let's talk about choosing the right call or put option. You need to have a view on the stock's direction and timing. Think it's going up? Buy a call option. Think it's going down? Buy a put option. Consider the strike price and expiration date. It's like catching the perfect wave. Timing is everything. So, there you have it. A crash course in options trading for volatile markets. We've covered a lot of ground, from straddles and strangles to volatility skew and naked options writing. But remember, this is just the tip of the iceberg. Options trading is a complex and challenging endeavor. It's not for everyone. But if you're willing to put in the time and effort to learn the ropes, it can be a rewarding experience. Just remember, don't be a hero. Manage your risk, protect your capital, and never stop learning. The market is always changing, and so should you. Trading in volatile markets is like navigating a stormy sea. You need the right tools, the right skills, and the right mindset to survive. But if you can weather the storm, the rewards can be substantial. So buckle up, hold on tight, and get ready for the ride. Be sure to like and subscribe to this channel. And check out the videos showing on the screen above to learn more about options trading.